Something strange happened to silver last Friday. It wasn't mysterious, but it showed just how fragile its pricing system really is. For hours, silver's price looked capped. Every time it tried to rally, it stalled at a very precise level. Buy pressure was coming in, volume was up, and momentum looked strong, yet the price just wouldn't respond like it normally would. To a casual observer, it probably looked like manipulation. To a trader, just looking at charts, it seemed like exhaustion. But to anyone who understands how silver is actually priced, it looked like a market under stress, trying to manage risk in real time. Here's the first thing you need to get, because almost nobody explains this clearly. Silver's price is not discovered where physical silver is bought and sold. It's discovered in paper markets, mainly through futures contracts on exchanges like the COMEX. These contracts are just claims on silver, not the metal itself. The vast majority are never settled with physical delivery. They're just closed out or rolled over. The system works just fine when confidence is high and volatility is low, but it starts acting weird when volatility rises faster than the system can absorb it. And that is exactly what happened last Friday. Silver had already entered a higher volatility zone after hitting a new all-time high last month. Once a market does that, the risk models change. Margin requirements suddenly matter a lot more. Liquidity gets selective, and the big players, banks, hedge funds, commercial hedgers, start aggressively adjusting their exposure. These adjustments are mechanical, not emotional. They're driven by capital rules, not by someone's opinion about where silver should be trading. This is why silver can look capped even when demand is strong. It's not that buyers have disappeared, it's that sellers with deep pockets and leverage step in to control their exposure, often at very specific price levels. These sellers aren't necessarily bearish on silver. A lot of times they're just hedging future production, offsetting their physical holdings, or just reducing risk after a rapid price move. But on a chart, the effect looks the same. The price stops responding to bullish signals. This is usually where the accusations of manipulation start flying, and it's understandable why. Silver has a documented history of illegal manipulation. JP Morgan was fined billions for spoofing and deceptive trading practices in the metals markets. That's a fact, and it proves silver is not some perfectly fair market. But it also creates a dangerous mental shortcut, assuming every unusual price move is illegal manipulation. Here's the uncomfortable truth most commentators won't say out loud. The majority of what people call manipulation today is actually structural distortion, not criminal behavior. Futures markets are designed to prioritize liquidity and stability, not to find the true price. When volatility spikes, these markets temporarily suppress price signals because risk control becomes more important than price discovery. This isn't a conspiracy. It's how the system is designed, but just because it's legal doesn't mean it's sustainable. What made last Friday so revealing is that there was no big news event to justify the stall. No sudden drop in demand, no interest rate shock, no geopolitical surprise. The only thing that changed was the perception of risk. Silver moved so fast that the system had to pump the brakes. And when markets do that, they don't send out a press release. They do it through order flow and margin pressure. Retail traders can't cause this. Coin shops can't cause this. Even a physical shortage can't immediately cause this. This kind of price behavior requires institutional players large enough to influence the futures market in real time. That doesn't automatically mean it's wrongdoing. It just means silver has reached a level where the big players have to actively manage their risk instead of just passively participating. Another key point most people miss is that short-term price suppression can exist alongside long-term bullish positioning. A bank can sell aggressively in the short term to manage risk while still being structurally bullish for the long haul. Futures markets allow for that flexibility. This is why looking at price action alone is a terrible way to guess intent. Selling doesn't always mean disbelief. Often, it just means survival. So, was silver manipulated last Friday? There's no evidence of illegal activity. But was it managed? Absolutely. And that distinction matters. Managed markets behave differently. They don't collapse easily, but when they fail suddenly. To answer whether silver is being manipulated today, you have to move past emotion and look at how manipulation actually works in modern markets. Manipulation is not just the price went down when I thought it should go up. Legally, it involves intentional actions designed to deceive others, like spoofing or colluding to mislead price discovery. These things have happened in silver before. JP Morgan's fines weren't theories, they were for proven misconduct. But what exists today is something more subtle and in many ways more powerful. Systemic control through structure. Silver trades inside a framework dominated by leveraged paper contracts, margin rules, and risk limits. These forces don't need illegal coordination to influence price. They operate automatically. When volatility rises too fast, the system pushes back. This produces outcomes that feel artificial, even when they're technically legal. The key misunderstanding is thinking that manipulation must be malicious. In reality, most price suppression happens because the system is designed to prevent disorder, not to discover truth. Futures exchanges and banks share one priority: stability. Price discovery comes second. That's a problem when physical reality starts to diverge from financial models. Silver is uniquely vulnerable to this because it has dual demand. It's both an industrial metal and a monetary metal. Industrial demand doesn't care about futures positioning. Solar panels and electronics need physical silver regardless of the price. Monetary demand rises when confidence in currencies or financial institutions weakens. When both forms of demand rise together, paper markets are forced to absorb pressure they were never designed to handle. This is why silver's price action looks so weird at critical moments. It's not because silver is broken. It's because its pricing mechanism is outdated for the role it's starting to play again. Now, let's talk about 2026, because this is where speculation often replaces analysis. Silver doesn't go up because people predict it will. It goes up when conditions force it to be repriced. There are only a few scenarios that realistically support much higher silver prices. First, sustained industrial demand. Silver use in green energy is not a fad. It's embedded into long-term infrastructure decisions. These projects don't stop because silver gets volatile. That creates a baseline of demand that didn't exist in previous bull markets. Second, monetary instability. Gold making new all-time highs isn't a silver-specific signal, it's a system-wide one. It tells you capital is hedging against something. Historically, silver lags gold, then accelerates. Not because it's better, but because it's smaller. That size difference means a relatively small amount of money can move the price dramatically. Third, supply. Silver supply can't respond quickly to higher prices because most of it is mined as a byproduct of other metals. Even if silver doubles, miners don't suddenly double production. This creates a lag. Rising demand meets a slow supply response. That's how price pressure builds. So how high can silver go in 2026? The honest answer is that price ranges higher than most people are psychologically prepared for are possible, but not guaranteed. Silver doesn't drift quietly into new price zones. It breaks into them violently, then tests them brutally with sharp corrections. Anyone expecting a smooth climb will likely get shaken out. A realistic bullish scenario involves silver holding higher structural lows and attracting both industrial and investment demand. In that environment, triple-digit silver is not impossible, but it would require either a massive surge in investment or a visible breakdown in confidence in the paper pricing system. Those are conditions, not predictions. The bearish case also has to be taken seriously. Silver has crashed before, even after strong rallies. Excessive leverage, sudden margin hikes, or a global demand slowdown could trigger deep corrections. Bullish fundamentals do not protect you from volatility. The most likely outcome is not a collapse or moonshot, it's a new volatility regime. Higher highs, higher lows, and far more violent swings. That environment punishes emotional trading and rewards understanding the structure. Silver is entering a phase where its price matters again, where paper markets are repeatedly tested by physical reality. This doesn't mean manipulation disappears, it just means it becomes less effective over time. This video is not financial advice. Investing always carries risk, and silver carries more than most assets. It's an explanation of how the system works so you can think clearly. If you've made it this far, subscribe and stay engaged because silver's next moves won't be boring. Now I want to hear from you. Where do you think the silver price is headed and why? Drop your thoughts in the comments. Thanks for watching.